Hello, I'm Michael Hainsworth. What a year 2025 has been. The biggest winners weren't necessarily the most glamorous, artificial intelligence notwithstanding. But as the Magnificent Seven represented most of the movement of most of the indexed funds, some investors have turned to bonds and gold over concerns the AI hype bubble is about to burst. This is Myles Zyblock. What do you say to a younger investor who hasn't experienced a valuation-conscious market environment yet?
Don't panic at volatility, focus on fundamentals, diversify broadly, and stay disciplined in your approach.
On this episode of On the Money, you'll be surprised by some of the winners and losers and what 2026 has in store. But first, lending money isn't without risk. Credit risk defines the possibility of not getting paid back. For bond investors, it's the difference between profit and pain. And for Canadians exploring fixed income for the first time, understanding credit risk is critical. Here's the basics. When you buy a bond, you're lending money to a government, to a corporation, or even a municipality. In exchange, they promise to pay you interest at the end of the specific date, and you get your initial investment back too. But promises aren't guarantees. A Government of Canada bond is considered virtually risk-free. But the interest rate, also known as the yield, is low because of it. A startup issuing a high-yield bond? That's a gamble. And we used to call them junk bonds before a big scandal blew up in the 80s. Now it's just rude. The higher the risk they might default, the higher the interest they have to offer you to attract your money. But you don't have time or the formal education to do the analysis. That's where credit ratings agencies come in, like Moody's and Standard & Poor's. They grade borrowers on their ability to pay. AAA, rock solid. Junk status means shaky at best. Investors chase higher yields sometimes, but not all the time, because they're called junk for a reason. If that company can't pay, your expected return turns into a real loss. Every portfolio should have bonds. When stocks fall, bonds rise, helping smooth out volatility of investing in the 21st century. As we close the books on 2025, the story of the markets isn't just about artificial intelligence rewriting the corporate playbook. It's about the ripple effects, the global surprises, the old school fundamentals that still anchor portfolios. Today, Dynamics Myles Zyblock is here to unpack the winners and losers and tell us what the pattern of returns reveals about risk, resilience, and where the smart money is going in 2026. Myles, AI stocks are growth stocks. Despite the correction, is it fair to say AI was the big winner of 2025?
I think it's fair to say that AI is having a major influence on the economy and financial markets, especially if one is focused on the U.S. AI investments in data centers, hardware, software, etc., is estimated to have raised U.S. GDP growth by about a percentage point in the last year. And that's a big impact for tech investments, more than double the average contribution to GDP growth that was experienced, say, over the last decade. So maybe it was the U.S. economy that was the big winner in 2025. The activity surrounding this AI theme has definitely powered corporate earnings much higher over the course of the past year. And this has translated into strong stock price performance, especially among the AI-levered themes. This includes everything from the hyperscalers we all talk about to those offering compute power, the AI enablers, and those tied to AI infrastructure like the data centers. They outperformed the S&P by close to 10 percentage points in 2025. So yes, they're among the equity markets winners in the past year. But, if you're to expand the investment opportunity beyond the U.S., then, many other winners were found. In fact, the Italian MIB equity index, the Spanish IBEX, the FTSE 100, the UK FTSE 100, they all outperformed the S&P 500 in 2025. And these indexes don't contain a single technology stock. Gold bullion and gold shares were also big performers in 2025. And I'm going to even add European aerospace and defense stocks to this list. They were up about 70%. While AI might have been one of the biggest stories in 2025, perhaps one with the most important economic influence. There were many other areas of the financial markets where above average performance was found. Like I said, it was a pretty good year, broadly speaking, for global equity prices and global equity investors.
You brought up two very interesting points. One, that while AI was on the rise, it was almost a rising AI tide lifted a lot of boats that were only tangentially related to artificial intelligence. But then you also bring up that in other places around the world that didn't have the magnificent seven of tech companies, that they gained as well. To what do you attribute the gains that we did see overseas?
Look, first of all, earnings started to act a little better globally. That's helpful, right? That's helpful. Second, these earnings were acting better when many of the stocks in these indexes were truly at depressed valuations. So people, I think, thought maybe the valuations that were attributable to these or attributed to these stocks were no longer justified by the fundamental outlook. So they bid the stocks up. I think there was a little bit of interest in the value style globally, maybe not in the US. But there was an interest in the value style globally. And I think that drew some funds into these areas of the market.
With all the saber rattling that we're hearing of south of the border, what role did that push into more defensive plays play overseas? You mentioned defense was very popular.
Well, defense stocks themselves, yes, they got a big lift. And, part of, I think, what was driving that whole theme, at least internationally, was the announcement by several countries like Germany, where they said that they were going to, the government were going to put a lot of funds into defense spending. And as you know, there's been a lot of push or a lot of pressure, let's say, on a number of countries to get their defense spending as a share of GDP higher. Obviously, President Trump wants them to spend more on defense. And like I said, Germany is following through with a big budget that's focused on defense spending. And again, that got people very excited about the prospects for the aerospace and defense industry.
Bond markets were winners in 2025. What does it tell you about the investing environment when we see both equities and bonds rise?
You're right. Global bonds generated close to a 7% total return, and that they were led by corporate bonds, which delivered even better, closer to 10%. And as we know, equities also delivered solid double-digit returns in 2025. So like you say, these two major asset classes gained ground at the same time. In part, this tells me that investors don't view global inflation as a major problem. And let me try to explain what I'm saying here. So we looked at returns over the past 150 years for both equities and bonds. Returns for the two asset classes, equities and bonds, have tended to moderate when inflation rises, but generally remain positive until inflation moves above 4%. Then both asset classes returns turn negative. And so, I guess the question is, why does the 4% level, why is it such a sort of a magical number? And I honestly don't know that. But instead of getting hung up, I guess, on the threshold, the 4% threshold, I think the more interesting information to extract from this historical data is that asset price performance and accelerating inflation aren't the warmest of friends. Remember back in 2022, this is a period when inflation surged higher, and both equities and bonds entered a steep performance decline. So history, I think, would support the idea that today's investors are not overly concerned about global inflation, given that the performance of equities and bonds are rising together.
There's a phrase that goes, there are bulls, there are bears, but it's the pigs that get slaughtered. For any investor who's seen strong gains in 2025, what's your advice?
So my advice on investing is and has been largely independent of the returns one experiences in the recent past. So, complex adaptive systems like economies, financial markets are incredibly difficult to predict with any precision. This gentleman by the name of Alfred Cowles penned a research paper in the early 1930s, and it was titled something like, "Can Stock Market Forecasters Forecast?" And he found that their forecasts were no better than a coin toss. So my advice is to ensure that a portfolio is well diversified, both within and across the major asset classes. And this idea includes stocks, bonds, and alternative investments. Diversification to me is the acknowledgement that the future is uncertain, And it's an approach that served investors well over time. So I think trying to time the market swings has, for the most part, enacted a heavy toll on investment returns through time. Research studies show that that investors tend to sell when they should be buying, and vice versa. So remaining invested but diversified seems, in my opinion, like a sensible approach for achieving long-term investment success.
Your historical example of forecasting reminds me of the stock picking chicken.
What is a stock picking chicken?
You grab the newspaper, you take out the stock printout page, you put a chicken on top of it, and the one that it does its business on is the one you pick. And apparently, it does fairly well.
I don't I don't know any. That's great. I mean, if that's true, that's awesome. I think we should maybe hire the chicken, but I don't recall that story. So I'd love to. I'm going to look that up for sure.
AI in 2025 was a rising tide that lifted most equity boats. That both stocks and bonds rose in tandem tells us the smart money isn't really losing any sleep over inflation. The same can't be said for value investors. Their strategy was the cornerstone of a disciplined portfolio forever. But value investing has spent more than a decade stuck in the mud, and 2025 was no different. Why? Value investing generally sees cheap equities outperform expensive ones. It's worked for most of the 20th century, just not the last 10 years or so. So valuation-driven strategies again lagged the broader equity market in 2025. Does this underperformance signal to you a structural shift?
So, Ben Graham, you're bringing this up. Benjamin Graham, he's widely regarded as the father of value investing. And he was among the first to notice, like you say, that the merits of buying an asset whose price sat below the estimate of its intrinsic value. And, it's been an approach that served investors well, generating excess returns for the better part of the past 100 years. Well, like you say, that was until I think it was about 2007. When the performance tide seemed to shift against the value style of investing. And look, value continues to make money, but just less money than what could have been made adopting another approach like the growth style of investing. And this struggle for value represents the longest relative performance drought for the style in the history of available U.S. financial market data. And I think several explanations for value's challenges have been offered, some of which are more believable or empirically credible than others. And probably the most important explanation, at least in my mind, is tied to technology's dominance and intangible assets. So the rise of large technology companies with high profitability, but low tangible assets has made, some valuation metrics like price to book less effective in signaling prospective investment opportunity. And, we also know that value indexes tend to be more heavily weighted towards financials, energy, and I guess other cyclical companies, which were hurt by the post-2007 deleveraging and at times low commodity prices. Note this is really, and I sort of addressed this a little bit earlier, it's more of a U.S. phenomenon than a global situation. I just looked at my Bloomberg terminal earlier this morning, running the numbers on the performance of value and growth in the non-U.S. part of the global equity market. And here I found that since 2007, the annualized performance of value and growth were almost identical. On a 1, 3, and 5-year period, non-U.S. value has actually smartly outperformed non-U.S. growth. On a 10-year period, value has also outperformed growth, but to a lesser extent. And like I said, since 2007, the annualized performance profiles for value and growth are a match. So it's a little bit different experience going on in the rest of the world.
You point out price to book is less effective when analyzing potential investments. And when it comes to Ben Graham, I think his big quote was, in the short run, the markets are a voting machine, but in the long run, they're a waiting machine. If some of the metrics we use to determine the value of a stock isn't as valuable as it used to be, what do we do?
Well, we adjust our valuation. I mean, still price to earnings seems to work okay. Price to cash flow, EV to EBITDA. There's a lot of different measures we can use that don't lean on Back in Ben Graham's day, the economy was very capital intensive, with big manufacturing centers and things like that. And those valuation measures that leaned on that idea were helpful. But now, like I said, a lot of these companies are capital light. Technology companies, there's not a lot of capex there, not a lot of, big machinery involved. So, we're still all about trying to assess the expected cash flows for a company that are delivered to shareholders. And so, valuation is important. We just have to tweak our value metrics a little bit.
You keep trying to pull me back into the recognition that the United States is not the global market, that it is just one. But we are so intrinsically tied to it, not just as Canadians, but as Canadian investors. So let me ask you this. The U.S. has stopped releasing some very important economic data. What does that tell you about the economy now?
The U.S. is really important. It's the largest economy in the world, and it's about 70% of global market capitalization. So it's important. The pause in the release of economic data was only temporary and lasted while the U.S. Government shutdown was on. And through the shutdown, we were able to lean on private sector data providers to help guide us through this government data drought. There are private sector readings you can get on the labor market, manufacturing, the consumer sector, and other areas. But more importantly, I think we had U.S. corporate earnings reports flowing in over this period of the shutdown. And the message contained in the earnings transcripts and the earnings results themselves were telling us that the U.S. economy was still in pretty decent shape. In fact, revenues in the S&P 500 revenues were reported to be up 8% through that period, year on year, and earnings jumped about 14% higher on a year-over-year basis. So, what we thought is that the economy must be, again, in pretty good shape for companies to be delivering these kinds of numbers.
We've learned that the story of value investing is more nuanced than a simple lost decade. Traditional measures like price to book fail to capture the rise of capital-light technology companies. And the United States is the outlier in a world where value still shows signs of life. But what about 2026, when the true impact of tariffs will be felt? I wanted to understand what the canary in the financial coal mine would be. Myles tells me, unemployment rates. Myles, you've told clients that modern equity markets are inelastic and that prices need to adjust significantly to absorb even a small shift in demand. With the tariff-driven inflationary environment in the United States, what does that tell us about the future direction of equities as Americans pinch pennies in 2026?
Let me start by saying there's a growing debate around the link between tariffs and inflation, actually set off by some recent research out of the Federal Reserve. And I'm going to offer you the standard view on tariffs before moving back to this Fed research, which I think is really important. So, the weighted tariff, U.S. tariff rate on its imports has risen from about 2.3% before President Trump entered office for a second term to, let's call it 15% more recently. So assuming full pass-through from these higher tariff rates, the analyst community estimates that inflation would be as much as 1.7 percentage points higher. Domestic businesses and foreign suppliers appear to be, or at least they've absorbed a meaningful share of these tariff increases, at least thus far, which might be why inflation isn't higher than it is. Pass through of higher tariffs onto final selling prices, I think it's incomplete. Although full pass through, like I talked about earlier, seems very unlikely under almost any imaginable economic circumstance. However, if companies can't pass through more of these tariff associated costs, they might have to start laying off workers a little bit to protect their profit margins. And then this leads me into that Federal Reserve research note I referred to, and it was published actually in late November of 2025. And it found that the impact of tariffs on inflation might not be as straightforward as many economists currently believe. That the note looked at a collection of data covering 40 years, many countries, and concluded that following a rise in tariffs, the unemployment rate for the country initially increases, but then inflation declines. So it's the rise in the unemployment rate that pushes inflation lower initially. The longer term dynamics of tariffs, say over 2 to 3 years, they might be a little bit more inflationary, with those pressures coming from the supply side. In other words, there's some evidence in support of the idea that the initial tariff shock is slightly disinflationary, since it helps to push the unemployment rate higher, lowering wage inflation, lowering consumer buying power. So, now all of that said, let me move over to what this might mean for equity prices. Equity price returns are driven by two things and two things only. The first is earnings growth, and the second is the change in valuations attached to those earnings. So the price return for the equity market is the sum of earnings growth plus the percentage change in the PE multiple. Add those two up, and that's your price return. And I think, earnings growth is likely to come in, let's say, close to 12% in 2026, given our views on the economy, revenue growth, and profit margins. The PE multiple is inversely linked to inflation, so higher inflation usually associated with lower valuations. Regardless of how one comes out on tariffs, to me, it just seems like inflation probably doesn't have a lot of immediate downside from here. And it's equally plausible that it probably doesn't have a lot of upside from here either in this sort of, say, a year horizon. So my personal view is it probably remains a little sticky. Thus, I'm not expecting any additional lift for returns from further increases in PE multiples. So I could see equities being largely driven by that 12% earnings growth in the year ahead.
Well, not an encouraging sign. That the reason why we might not be so concerned about inflation is because Americans are going to lose their jobs in 2026. AI is alleged to be, responsible for taking some of those jobs. What happens to AI-related investments in 2026 after everything we've seen in 2025?
Well, AI investments, that's an incredible story. I think the CEO of NVIDIA expects there to be $3 to $4 trillion globally invested in AI out to 2030. Over the next year alone, just taking, the company's forecasts, we could see over $1 trillion over the next couple of years invested in AI, $500-600 billion a year over the next couple of years. And so I think that this story, there might be longer term concerns here of whether, you're going to see a return on this investment. But I think it's too early to say. We're still in the early stages. And I think this AI boom likely powers forward for at least the next 12 to 24 months.
You don't see us pulling back, we ran a little bit too far. Now we got to pull a little bit back, because the pendulum always seems to swing too far one way or the other. And it feels like 2025 swung a lot.
The last time we saw something like this was the late 1990s, when, a lot of fiber optics were laid and all that sort of stuff. But it took a few years for us to figure this all out, right? And we're only, this ChatGPT thing just kind of happened, and that's what sparked the fire for this whole thing. And it just kind of happened. So I think we're still in the very early innings of this story. So I'd say there's probably some blue sky over the next 1 to 2 years, at least around this story. Obviously, there's going to be some concerns. We already saw it, to pay for some of this AI investment. Some of the large tech companies have issued bonds. That's kind of spooked the credit market a little bit. So we're going to see, like I said, some hiccups along the way, but I don't think we're going to see enough of an issue to challenge this investment cycle, at least over the next little bit.
I've enjoyed our time together because we've got to geek out a little bit on AI, but also because we've talked about something that I don't think I'm hearing enough about. So to you, let me ask you this. What do you say to a younger investor who hasn't experienced a valuation-conscious market environment yet?
Don't panic at volatility, focus on fundamentals, diversify broadly, and stay disciplined in your approach.
Always great speaking with you. All the best for the new year.
And thank you, and same to you, Micah. It's always great to be here.
Myles teaches us that value investing struggles are less about failing discipline and more about a changing economy, and that the path forward for equities will depend on how inflation, earnings, and valuations collide in a tariff-charged environment. The winners of 2025 extended well beyond the AI hype cycle, and that the next chapter of AI investment may not be a retreat, but an acceleration as capital continues to chase long-term transformation. Whether you're a seasoned investor or just starting out, the message is the same. Stay focused on fundamentals, diversify broadly, and keep a steady hand through the volatility, and you'll be on the money. I'm Michael Hainsworth. Thanks for joining us.